Right now in Canada, the Bank of Canada just held its rate at 2.25% for the fourth straight meeting. And they all but killed the rate cut millions of homeowners have been waiting for. The exact words were small moves ahead and we need flexibility. So that's central bank code for don't expect us to come to the rescue if you need rate cuts. If you're sitting on a renewal or looking at refinancing in 2026 and you've been telling yourself you'll just wait it out for cheaper rates, here's the brutal truth. On a $500,000 mortgage, every month you wait at today's posted bank rates or whatever you're at is costing you somewhere between $300 to $400 in payment shock you didn't need to take. Math doesn't care about headlines, so instead of guessing where rates are going to go next, let me show you the exact structure that smart Canadian homeowners are using right now to cut that shock in half without trying to time the market and without taking a gamble on strictly a variable mortgage. Here's what you'll learn. Why the cut you've been waiting for probably isn't coming, the trap most renewers and people refinancing are falling into, and the structure your bank probably won't mention. Let's run the numbers. If we look at the hard data, the Bank of Canada held at 2.25, and as mentioned, it's the fourth straight hold. So what does that mean for you? The prime rate that drives every variable rate mortgage in the country is frozen. No relief is coming on your variable payment. Inflation jumped to 2.4% in March and is expected to peak at nearly 3% in April, mostly based on gas and food prices. But what does this all mean? It means the bank now has a reason to not cut, and maybe even a small potential reason to hike if energy inflation spreads and becomes broad-based inflation. Growth is forecasted at just 1.2% in 2026. And what does that mean? Well, the economy isn't strong enough to force bond yields back, which is the only thing that would meaningfully drop fixed mortgage rates right now. But it also is not weak enough to force the Bank of Canada to cut interest rates. You're kind of stuck in this messy middle, and that's kind of the worst part about making a renewal or refinance decision right now. The bank's own words were that they're navigating blind spots and that future moves would be small. Translation? The parade of rate cuts that people have been waiting for to bail them out at their renewal or to help refinance into lower rates, well, that may have been canceled. The next move could just as easily be a slight hike or a slight cut, depending on what inflation in the economy does. The key takeaway from this is that it will be slight. It's going to be minimal. The funny thing is, I've always said hope is not a mortgage strategy, but now it seems like even the Bank of Canada has that strategy. So the renewal that you're walking into is the renewal you're walking into. The question isn't when do rates drop, it's how do I structure this so I'm not the one taking the hit either way. Here's the part that really moves refinance or renewal. Bond yields. Fixed mortgage rates don't follow the Bank of Canada. They follow the 5-year Government of Canada bond yield. That yield has been stuck in the 3 to 3.5% range for almost 6 months now. In 2020 and 2021, it was under 1%. That's why your old fixed rates were like 1.99%. Until that bond yield drops meaningfully, and there's no major bank forecasting that this year, fixed rates are not going to be going down, and they're going to probably stay where they are or potentially increase depending on what happens with the US and Iran. The variable side has already done most of the work. Prime is down 275 basis points from the peak. There's maybe 25 or 50 basis points of cuts left in this cycle, and that's about it. So both sides of the mortgage market, fixed and variable, are flattening at roughly the same time. Right when about 60% of Canadian mortgages are coming up for renewal between now and the end of 2026. The translation of this, if you got a mortgage rate of 1.99%, you're not going to be renewing back into 1.99%. The cheapest renewal you're realistically going to be looking at right now is somewhere between the mid 3s to mid 4s, depending on product, term, and placement. And that gap between what you used to pay and what you're about to pay is the entire problem that this video is going to help you solve. So here's what 90% of Canadians sitting at renewal are doing right now. They're going variable. They're hoping for cuts, they're accepting the lower rate today, and gambling that the Bank of Canada is going to keep cutting through 2026. And honestly, I get it. Variable looks cheaper on paper. However, the struggle with this is that a lot of bank reps or other people are telling them that prime is going to keep coming down. Most of the headlines say the exact same thing. Their neighbor who renewed 6 months ago is telling them their variable saved them money. But that's not a strategy. That's hope. I see this play out every single week with new clients. Someone takes a variable because it's the cheapest option today with the cheapest payment. Then rates don't move the way that they expected. The payment stays the same. And all of a sudden, it's not a question of what's cheaper. It's, why does this feel so stressful? Why didn't I lock in? Should I have locked in? And the reason for this is the waiting game only hurts you if you don't know the rules and if you don't know your numbers. So let's get into the actual numbers of this. Let's run the real numbers on a $500,000 mortgage with a 25-year amortization. Today, with a variable rate of around, let's say, 4.2% and a fixed rate of 4.89. Variable monthly payment is roughly around $26.80. Fixed payments are about $28.91. So variable looks like it saves you about $211 a month. So about $2,500 a year, which sounds great. But the number assumes rates behave the way that you want. Let me show you what actually happens in two scenarios. Scenario one, rates stay flat, which is exactly what the Bank of Canada just signaled today. 12 months from now, you've saved $2,500 versus locking in a fixed, which is nice, but you've spent the entire year carrying that payment thinking, oh, good God, what if rates were to go up? And you're not really any further ahead on your mortgage than someone who locked in at 4.89. You win a small amount of $2,500, but you have that added level of stress. Scenario two, rates drop by 25 basis points or a quarter point, which is being forecasted in by some, but nothing really further than that. Your variable payment drops by about $65 a month, starting whenever the cuts actually land. Over the back half of the year, that's maybe $400 in additional savings on top of the $2,500. So your total upside is about $2,900 versus going fixed. Now, ask yourself, is $2,900 worth 12 months of watching every Bank of Canada press conference, hoping bond yields cooperate, and carrying the risk that you or the headlines could be wrong? For some people, the honest answer is yes, but for some, it's no. The problem is when you don't even know that there's a third path. Now, you might be thinking, Myles, this sounds great in theory, but is there actually a smarter play here? Let me show you the structure that most bank reps won't put on the table and the reason why. It's called a hybrid mortgage. Some lenders call it a split mortgage, some call it a 50-50. The branding varies. TD has their own version as well, just like Scotiabank has theirs. A handful of monoline lenders offer it too, but here's the catch. Not every lender offers it, and even the ones that do don't lead with it. It's more work for them. It doesn't fit the script their renewal team is running, and most renewers never even know to ask. And just so we're clear, this is not a blended rate from your existing lender. This is a brand new mortgage structure at renewal with two separate components to it. Here's how the structure works on the same $500,000 mortgage. Instead of your full balance being at one rate, you split it. You take $300,000 and put that in a fixed rate at, let's say, 4.89%. That's your stress test proof base. That's the portion that protects you from payment shock no matter what rates do. Then you put the other $200,000 in that variable, let's say 4 or 4.2%. Now, if the Bank of Canada delivers that one cut that some forecasters are holding out for, you capture it on the variable portion, about $40 a month back in your pocket. If they cut twice, that's closer to $80. Meanwhile, that $300,000 fixed portion keeps the bulk of your payment locked in and predictable. If rates don't drop, which is kind of what the Bank of Canada just told us is the most likely path, your fixed portion is doing its job, and you're no worse off than going pure fixed. If rates drop more than expected, you participate in the upside on that variable $200,000 portion. You stop guessing, you stop hoping, and you start actually hedging. Now, and this is an important part you need to know going in. Not every lender offers this, and the ones that do all have different rules on how you split it, what you can prepay, and what your renewal options are going to look like. So the real question isn't, should I do this? It's, which lender will let me do this on my specific mortgage? That's where the legwork lives. And if you want help figuring out whether a hybrid mortgage is even available in your situation and which lender would actually offer it to you, there's a link in the description below. No pressure, just clarity to try and figure out if it's a plan for you. And one more thing, if you're not at renewal, but you're sitting on a buildup of equity wondering if you should refinance or consolidate debt or pull out cash before rates move again, the next video on the screen breaks down the exact math on what that looks like. So watch that next. My name is Myles Nowik, owner of the Nowik Mortgage Team, powered by Andy Mortgage. If you got value out of this video, hit that like and subscribe button so more people like you can see it, and we'll catch you on the next one.